So today I want to talk about the most recent Canada inflation rate. We have great news after a fantastic long weekend. I hope everyone had a great Family Day long weekend. The report for February, which is in reality January's Canada inflation rate, came in at 2.9%, which is fabulous news. The market was expecting 3.3%. We have to remember the last announcement 30 days ago was Canada's inflation was at 3.4%. So a very significant drop in inflation and very similar to where we were in June of 2023. When we look at the US inflation rate that was just recently announced, they're at 3.1%. So a reduction, and they are trending in the right direction. So with both countries, we're looking at inflation to be at 2%. When we're looking at where the economists forecast for this year in 2024, we should be very close to that target rate of 2% by the end of this year and specifically into 2025. So really good news. And I always say, with what we have gone through in this economy and this country with housing and inflation and lack of savings, that we've seen over the last 12 months, this is a huge win, and we do need to celebrate wins. Looking at a lot of the media that's out there on their commentary over today's announcement, there is information that's saying, okay, inflation has come down, but that food prices are still high, but reducing slower. So yes, there are some struggles when we're looking at significant aspects of what the inflationary rate is comprised of. And food prices are still high, but overall consumer spending has slowed down, government spending has slowed down. We know that our supply chain has increased for more opportunities to purchase and also utilize a lot of resources to help with various infrastructure and different economies within our country that will help us alleviate some of the inflationary pressure. But when we're looking at it from the perspective of why inflation is so sticky right now, and I've talked about this numerous times, inflation is comprised of one of the biggest pieces, which is our mortgage interest. So our mortgage interest is what we've seen increase exponentially over the last 12 months. We have our mortgage interest being at about 29% of what's comprised of inflation. And we know that the government has used this tool of mortgage interest to help slow down our economy. So, from one aspect, they actually have done their job and continuing to do the job to get to the target place of 2%. But when looking at inflation being reduced, there is time and pressure for this government to start decreasing bank prime and also starting to see fixed rates come down as well. And this is what I wanted to show you on this slide. This gives you a breakdown. Now, I did a bit of a history on this for the last 12 months, and we can see that mortgage interest costs have actually increased the percentage of how much is utilized in our inflation. We're at 29%. Now, this is showing as of November. We haven't seen much of a decrease in this, but this is what's causing a lot of our inflation to be so sticky. And when you look at it from clothing to food prices, especially let's look at food prices, at the peak of the highest point of cost of food, we were looking at that being at the end of 2022. We definitely have seen about a half a point reduction on food. So we are seeing that groceries are becoming a little bit less expensive. And so overall, when you factor all this in, it's helping us bring down inflation. Rent, you can see here, rent accommodations has gone up. It's gone down from, back in October, but we're dealing with a lack of supply out there and a demand on not only owning a home, but if you can't home, you need to rent. So we're still seeing that pressure on the market. And the only thing to alleviate that is going to be building more homes, more purpose-built rentals, a combination of both so that the market can balance out. But overall, we start to see mortgage interest costs come down with rates being reduced and where the forecast is. So let's talk about that. One thing I wanted to show on this slide, which is our CPI, our Consumer Price Index. And why I'm showing this is a breakdown of what is comprised of inflation. Now, why I'm showing this to you is when you look at the shelter cost specifically, you're seeing that shelter has always remained very high in our inflationary rate. And you can say, well, inflation was at target point at that 2% for many years, very close to it, even under it. But we have to also remember that values haven't increased the way that we've seen in the last 4 years. Given the up cycles and down of house prices, overall, we've seen an increase in housing prices in Canada by 25%. And so we're seeing that everything has increased exponentially. So it does hit people's pocketbooks, and reduced savings we're seeing in this country is at the lowest point that we've seen. So it's causing people to really feel it in their pocketbooks. And so every piece of this is very sensitive to overall inflation and what we feel, because we've had this for a significant amount of time. When you actually strip out mortgage interest, so that 29% that I showed you on the last slide, we'd be sitting at inflation. Now, this is just showing you back in July of last year. We were actually at 2.4%, which is very much close to target rate. David Rosenberg, who's an economist with BNN, said back in October we were actually at 1.9%, which is under target rate. Today, with the announcement of Canada's inflation at 2.9%, if you strip out mortgage interest, which is really relevant to today, um, we'd actually be right now close to 1.9%. So we would be really at that target rate. So you can say, well, why have rates not come down, and why has bank prime not come down? And the Minister of Finance, Tiff Macklem, is providing what they call a very hawkish approach, which is a conservative approach to decrease bank prime. When we saw this last year, and they decreased bank prime by a quarter back in April and May, we saw very strong activity in the housing market. It created a lot of momentum that the government wanted to actually not see, so that we could continue to see inflation stay very close and reduce to that target rate of 2%. And so why we saw an increase in bank prime last year and then a pause. And so the government will be very slow to start decreasing interest rate, knowing the pent-up demand of supply, of owning a home in Canada, and the lack of building home initiatives to actually keep up with the demand on that. And I'm going to talk more about that later on in the PowerPoint. So, this slide is about the labor market and how weak the labor market is. We don't have enough jobs, especially for the skilled labor that's needed to actually build homes and other different businesses that are linked to home ownership. And what I wanted to show here, and not to overcomplicate inflation, but they talk about a very strong payroll, and the government talks about how many jobs have been created month to month. But when you actually look at it, the job creation isn't of full-time jobs, it's actually part-time jobs. And you can see that in the bottom of this slide where it talks about part-time employment. We actually saw an increase of 49,000 jobs created from the previous month, which was 23, so double amount of part-time jobs. So what does this tell you when you're looking at this? And what I highlighted about full-time jobs actually decreasing by 11,000. So we're not creating the jobs, the full-time jobs, for a sustainable, a balanced economy. We're seeing more part-time jobs. So people are taking more part-time jobs to be able to cover their bills right now. And that isn't an actual robust economy in Canada. And why I put on there it's a bust, because it's a very struggling economy right now in Canada, and why this government's going to be very pressured to decrease interest rates. The hourly wage is very important there, because we're seeing that decrease, but we're also seeing the amount of hours that people are spending at a job decrease as well. We're seeing that 4-day work week, not the 5-day, and that affects overall hourly wage as well. So that has to take in consideration. And these numbers that the economy posts on a weekly basis affects our 10-year treasury rate in the US, our 5-year government bond rate, which affects our fixed rates. And that goes up and down. And this is why you see some volatility on fixed rates. But overall, we've had about 100 basis point reduction in fixed rates in the last 30 days. And we're going to continue to see that competitiveness on fixed rates. I spoke to many lenders and banks. That spring market momentum of competitiveness on interest rates is significant. And we're going to see that be very substantial going into spring market, especially if you're coming up for renewal. It's something to take a look at. And this is where I'm showing you with the 10-year treasury and the government bonds, how sensitive that is to any type of news on where we are overall in the economy, talking about payroll numbers coming in weaker or stronger. You can see the difference here, and we can see that the 10-year treasury and the 5-year bond yield very much correlate together. And that up and down is very sensitive to where we are with interest rates. So GDP correlates very much, or it should correlate very much in line with our CPI and our inflation rate. So if we're at 2.9%, this is where GDP can be. And you can see right now, we're nowhere near that. We're actually at zero, so we're flat, which means the economy is not robust. We're not functioning in a very productive economy. So when you look at the forecast here in Q2, Q3, Q4, you're starting to see that pick up some momentum. And I think that will be because interest rates will start coming down, inflation is getting better. And we should be, when you look at Q4, we're going to be very close to that target rate of inflation at 2%. We should be able to see that our GDP will be matching to that and be at 2%. And you can see in 2025 and on, it'll be stronger as well. So this is very good positive news for where we're going. Not where we've been, but where we're going. So when you're looking at home ownership and you're looking at what you need to do with your mortgage, you should be looking at these type of numbers to see that the light is there and that we are recovering. Yes, it's been a slower recovery, but the recovery is going to actually come quite quickly. And when we look at GDP, and I talked about, that correlating to inflation, you can see the red line here is actual government consumption, which is government spending, and the blue line is GDP, right? Which is how our economy overall functions. So our government spending is actually outpacing our GDP, and that's what's causing a lot of our inflation as well. In fact, if you strip that out, we'd actually be very close to 3%, our target rate of bank prime. And so this is where a lot of economists, a lot of banks are really putting the pressure on the government to start decreasing interest rates, because the government spending, it's not consumers that are causing this. It's more on the government side where they're spending too much during an economy that really is significantly slowing down. And we are battling that inflation rate to get to that target rate of 2%. So where are we going? And what I'm going to show here is I'm just going to bring up all of the forecasts so that I can talk about this in general, is about inflation in Canada, interest rate in Canada, and also the US interest rates and inflation. So when I look at, just going to bring this up here. Okay. Oops. So when I look at Canada's inflation, we're going to be seeing here that the bank prime rate, which is the interest rate at the top there, we're seeing right now being at 5%. And by the end of this year in 2024, we'll be close to 3.5%. This is what the economists are forecasting. Now, I've seen some changes on this, but overall, we should see a full maybe 1 to 1.5% decrease. So when I'm talking about when these decreases in bank prime will start, and it's been pushed to the middle of this year, you can see how aggressive it's going to be at the end of this year. And this is why with any type of reduction in bank prime or fixed rates significantly, we see the momentum of the housing market pick up. And this is what you need to be prepared for if you are looking to buy or sell your home, or do, if you're coming up for renewal or looking to do some options on your mortgage of refinancing. You need to be very sensitive to this so that you can prepare properly. The US market, when we're talking about their Fed rate, their Fed interest rate, they're not going to come down as aggressive as we are in Canada. They're going to be down to about 4.75. So maybe a point and a quarter by then. We'll have to see how that goes, because I know it's a bit of a harder fight for the US. There's a lot of consumer spending, still a lot of confidence in that market and consumer spending. A lot of debt increase, which we've seen in Canada, but more significantly in the US. Talking about inflation, we're currently now at 2.9%. The forecast for the end of this year is 2.2. So very close to that target rate of 2%. We will be seeing that in 2025, and that will come perfect timing for a lot of mortgages. The majority, actually, bulk of mortgages in Canada coming up for renewal are going to be more in 2025. And so this will help in terms of giving people more options on what they need to do with their mortgage, specifically if you need to go back into a variable. And I'll talk more on that later on. with the US, their inflation rate will be about 2.5, so slightly higher than Canada at the end of 2024, but definitely going in the right direction. And we have to remember, I always say this, when the government in the US sneezes, we get pneumonia. And sometimes that can be in a good and a bad way. But overall, we're going to be trending in both countries in the right way, which is 2% target rate for inflation. And that should happen close to the end of this year, but definitely into 2025. So this is showing you, which is a very, very important slide, on what the economist sentiment is on bank prime in Canada and when these decreases will start. So when you look at March the 6th, which we're coming up to in 2 weeks, the 5% is where we're at right now with bank prime. 91% of economists feel we will have no change, so no increase or decrease, and 9% think we'll have a 0.25% decrease. Now, so this is why we're saying, and most people are, that we will not have a change in bank prime in March, nor will we have one in April. There's more of a bit of an opportunity, but I think the Bank of Canada will be more conservative on that decrease. Where it becomes interesting is in June and July. And you can see here, it's pretty much split in June, on June 5th, whether or not we'll see that decrease of a 0.25%. I think as time goes on and we see how aggressive inflation comes down, this might actually increase more, that we'll see that decrease in bank prime. But for July, this is really the sweet spot where most economists are saying, okay, the Bank of Canada now will have to start decreasing rates. We'll see that 0.25%. We're seeing an 87% consensus with economists that we will see that 0.25% drop. So this is great news. And more importantly, the next three announcements, which are the remainder ones for 2024, are decreases by a 0.25% and then a 0.5 point at the end. So when we're looking at this, if we say we start in July for the 0.25% reduction, we're actually going to see about a 1 to 1.25% reduction in bank prime by the end of the year. And a lot of the economists, specifically Scotiabank, when we look at CIBC, they're actually saying 1.5% reduction. So even more than the overall economist sentiment. We'll have to see how things work in terms of inflation still remaining low and consistently remaining low. But the overall sentiment, when you look at this, and which is fantastic news, is no more increases, decreases in bank prime. And so the opportunity to look at variable rate mortgages is going to be something you need to consider for your mortgage, specifically if you're coming up for renewal or even buying right now. If you can weather the storm right now of that higher payment, knowing that where the forecast is going on rates so that you can take advantage of it. So 5-year bond yields, this correlates to where fixed rates are. And you can see by this graph that we're starting to see the momentum of 5-year bond yields come down. There's a little bit of influx depending on what the economist numbers that are coming out on payroll numbers, on consumer confidence, consumer spending, government spending. But overall, bond yields are coming down, and that very much drives our fixed rates. And we're seeing fixed rates come down. So when looking at where we are and the forecast, and this is really what I want to show you, is some big wins right now and opportunities for your mortgage, for your purchase, for your refinance, for your mortgage coming up for renewal. I'm specifically looking at the end of this year, and this is what I highlighted, December 31st of 2024. The Bank of Canada bank prime rate, they're saying will be about 6.45. You have to remember there's the Bank of Canada rate. That's what the bank lends on. And then our consumer bank prime rate of what we have to pay when we're on a variable rate mortgage or a line of credit that's revolving on bank prime. So right now we're at 7.2. They're saying it'll be down to 6.45. But going over to the very end of the row there where it talks about 5-year fixed, we're saying that most economists are forecasting that 5-year fixed rates will be around 4.49%. Now this is posted rates. So keep in mind posted rates, when you're seeing them on websites, traditionally you can get discounts on that depending on your mortgage application, the strength of your application, length of employment. There are a lot of factors that attribute to that. But overall, when you look at this, rates are decreasing, whether it's a 1, a 2, a 3, a 4, a 5-year, a variable rate mortgage, bank prime's coming down. And I'm showing you the forecast going into 2028 that we'll see even more reductions. That's a very long forecast. I'm not saying let's hyper focus on that. But what you need to know is that bank prime is going to come down, and the opportunities for fixed rates, even though they will kind of fluctuate up and down, will be there, but the opportunity is there. And this is good news. So where I see some headwinds, and headwinds are actually not necessarily a bad thing. There are challenges for us as homeowners and mortgage holders, but puts pressure on the government to decrease rates sooner. So some of this is consumer debt rising. We're seeing that consumer debt at an all-time high in Canada and in the US, and that becomes very challenging for people to manage their payments. So we're starting to see credit card and auto loan delinquencies up sharply, and more specifically in the US, but we're starting to see that momentum in Canada. Monthly payments on ARMs, that's adjustable rate mortgages and HELOCs, payments are rising sharply because a lot of these variable rate mortgages have reset because they've hit that target rate where they're no longer paying interest or principal on their mortgage, and people having to readjust their amortizations because they haven't adjusted their payments if they're in a variable rate. So it's a hard payment shock for a lot of Canadians this year, and having to restructure their mortgage, the government is very cognizant of that. So knowing that we're a country that's really based on interest rates come down, the economy moves better. Early mortgage delinquency rising. Now, we still are at a very low percentage of mortgage delinquency, and I'll show you one of the slides on that. But we are seeing that rise specifically in private mortgage financing. So when looking at options for your mortgage, fixed versus variable, over the last 2 years, fixed rate has definitely been the number one choice when looking at mortgage financing because rates have been so high. People are not confident on where bank prime was going. And we saw an increase. We saw a 2,000% increase on bank prime over 18 months. So variable rate mortgages, or ARMs, adjustable mortgages, were not attractive. Now we're seeing that they're becoming more attractive, knowing where we're seeing the forecast of interest rates, of bank prime, of inflation, the opportunity to take a variable rate and then lock into a fixed rate down the road as rates come down, specifically into next year, is going to be a choice for a client if you can manage the payment and you're able to manage where the height is right now, knowing it's going to come down. You're going to be in the driver's seat to lock into a lower fixed rate in the future. And so the history of variable and fixed rates. Now, this is going back to 2013, but the orange line is variable. The blue line is fixed. Traditionally in Canada, more people do take fixed rates, but you can see in 2022, we saw about a 50% difference in more people were taking variable rate mortgages because bank prime was an all-time low. With the discounts, people were getting 1.5%. And we were also seeing that lower fixed rate as well. And where we saw the big differences in the last year, only 8.3% of people were taking variable mortgages, which makes sense. And the majority of people were taking fixed rates. But I do anticipate this will change this year. You'll see more people seeing the opportunity of taking a fixed rate down the road as rates come down and saving thousands on their mortgage. And this is why you really need to strategize and sit down with us to go through options on your mortgage and really position it strategically to where you are with your budget right now, where you are with your long and short-term goals, but more importantly, that you understand that that fixed rate opportunity is going to be coming in the future. So if you can withstand the higher payment right now, knowing you're going to save thousands later on, this is something that we can discuss. But everyone's financing is different. There's no one right choice for everyone because your bank account looks different than mine to the next person, and so does your mortgage. So we can talk to people about what they recommend and where there are your friends and family, but ultimately sitting down with us as mortgage professionals, looking at where you are with your budget, with your goals, and strategically aligning them with a product to help you save thousands of dollars is where we really are niched at, and to help you win with your financing. And let's face it, a lot of mortgages are coming up for renewal. 60% of Canadian mortgages are coming up for renewal in the next 3 years, and that's huge payment shock for people. So people have to be able to manage that and get ahead of this so that we can look at strategic options for you. The majority of mortgages that are coming up for renewal are actually in 2026, almost 400 billion at that point. But still, if your mortgage is coming up for renewal in the next 3 years, you need to have a call with us so that we can go through what today looks like and where you're going to be in the future. Because you could see your monthly payments increase as high as 48%. So we want to alleviate that for you. And there are options. We can look at increasing amortization. We could look at consolidating debt for payment shock. We could look at options of you potentially renting out your basement to offset some of the increases. But we can also look at the strategy of variable rate mortgage to lock in later on to lower rates. So it's a very in-depth analysis and conversation for us to help you win with your financing. So looking at if you are coming up for renewal, what's important here is that in December of 2019, if you are one of these people that got a mortgage in that year, you can see roughly the history of where your rate would be. And when you're looking at it in today's lens, at the very end of January 2024, you can see where interest rates are at. So let's say 4.99, which is on the very right part of this graph of a 5-year fixed rate, and you got 2.88. So you can see you're going to have a payment shock of over 2%. And that could be significant depending on your mortgage balance. So we have to help you through this to be able to manage that payment shock. And you can see specifically if you're coming up for renewal in 2025, the interest rates were at its lowest in that year. Actually, I should correct myself, in 2021 it was as well, but they were still significantly lower, under 2%. And so you're going to have a payment shock. So being prepared will help you be able to make the proper decisions on your financing. In 2026, this is where we're at the actual all-time low on fixed rates. You could see here 1.46 on a variable rate mortgage. And so people are going to have that payment shock. However, we know rates are coming down. Bank prime is coming down 2 years. The lens of rates is going to look very different than where we are today. But being prepared will help you make the best decision for your mortgage. And knowing that 60% of mortgages in Canada are coming up for renewal in the next 3 years, it's very important for people to have that strategy of knowing where they need to go. And so OSFI is our regulatory body in Canada, and they're becoming very strict, like very, very strict on these mortgages that did not fluctuate in their payments. So we call them our stagnant, or they're not adjustable rate mortgages, they're just variable rate mortgage payments. There's a lot of banks that were holding these ones, and you will have to readjust your mortgage if you are in one of these products so that your amortization comes down to 25 to 30 years. And I've been assisting a lot of clients with this. So keep in mind, if you are one of these clients that are in this stagnant variable rate mortgage, your amortization more than likely will be over and above what you originally got when you got the mortgage. And so we really need to strategize. And there's a lot of ways to be able to help you on this. So I just want you to make you aware that you need to connect so that we can do that. And I talked about mortgage delinquency. You can see from this graph, we are still at an all-time low, but it is slowly rising, and specifically in private mortgages. So if you do have a private mortgage and need some assistance, make sure you reach out. Or if you're up for renewal and finding that the payment is not manageable for you, make sure you reach out. We have lots of products that have extended amortizations over and above 30 years to really help you through this. So it's not to stay in this place. I always call it a Band-Aid solution for the actual win down the road. And sometimes you have to have a bit of a transition so that we can get you back on the right path, right? And talking about arrears on mortgages, now this gives you a perspective in Canada overall. Like I said, it's only 16% of mortgages that are delinquent in Canada. More specifically, they're more in the Maritimes, Alberta, Saskatchewan, Ontario and BC still seem very strong and able to manage payments right now, but we have not gone through the majority of renewals coming up in Canada. And so the government is very sensitive to these stats and understands where we're at. So the pressure of decreasing interest rates is still going to be there quite a bit, and very prevalent for the government to decrease interest rates quicker than expected. The housing shortage will worsen, and I do believe this. I think that we are not building enough houses for the amount of people that have moved into our country and are here to be able to create a life. And we should be able to have that. We can see the shortage. We have a lack of skilled trade workers. We're about 1 million trade workers short. And when we look at actual numbers here, and this is just a graph to show you that in the past year, the population growth grew 3.1%, which is 6 times higher than the US. And we're not even as big as of that country than the US to Canada. So you can see that we're inundated with population growth, but we haven't worked out strategies of housing supply, whether on the rental side or home ownership. And that's going to be one of the major issues of why we're seeing values continuously go up, even though rates haven't adjusted. People were finding ways to be able to purchase a home because they need someplace to live. And the number of foreign students that we have here, we're going to see them turn into permanent residents. So you can see the forecast there is going to increase. So that's going to put even more pressure on the housing market. And this slide specifically is on the rental sector. So 37% of Canadians are renters. Now, when I looked at stats before, this transition that we've seen on inflation and post-COVID, we were actually keeping up with the housing supply. So for every one house that was started, it would accommodate about 1.8 people in that home. Now, when we're looking at where the housing market is, for every house that starts, we're accommodating about 4.2 people, which means we're not even keeping up with the number of people that need to be having houses built. And so there's a huge gap right now. There's a huge gap in supply, and the demand is still there of home ownership, and why we will see values continuously go up. Population growth is at 40 million, right? So that's continuing to go up, and we'll see that trend put a lot of pressure on home ownership and supply. This graph here is very regionally. So I was doing a comparison of the blue graph is where Canadian values are on average, taking in consideration detached, single homes, condos, townhomes. The red graph is specifically, and why I'm showing this is in the region of where I'm living right now in KW. But what I'm trying to show here is how interest rates very much are sensitive to the demand in the housing market. So when we're looking at specifically where it says fixed rates falling spring 2023, SVP. So if we can remember back in March and April of last year in 2023, there was a bank crisis in the US, and a lot of the smaller, actually some of the bigger banks ended up collapsing, and the government was investing funds to keep them going, and there was mergers. So there's a lot of mergers. But what happened is that our fixed rates started to come down because of that, because there was no confidence in the market. Our bond yields were dropping and fixed rates came down. But you can see by the red and blue line that value started to go up actually quite exponentially. And the market started getting busy in that May and June, and we saw that. Bank prime actually went down as well. But then you can see where it says at the top line, fixed rates on the rise, Q3 2023. This is where the government made a correction. They corrected the bank crisis in the US. Bank prime went up a quarter, and fixed rates started going up. So you can see the decline of activity in the housing market. And this is showing you how sensitive we are as Canadians on interest rates. And with the forecast that I showed you on bank prime, on inflation, on fixed rates, we know housing values and activity are going to continue to go up. And this is why you have to get prepared for your mortgage. And taking in consideration here, it gives you a scenario of at the peak of values in March of 2022, a single detached home was 959,000. And scenario 2, in January of this year, we're at 762,000. That's almost a $200,000 difference in value of the same house. So we can say, well, the value was lost, but if you're looking to buy this, your down payment's $20,000 less, your mortgage amount is $177,000 less, you pay less mortgage insurance. And when we look at fixed rates, back in March of 2022, it was 3.19. In today's lens, we're at 4.89. So it's an increase of 1.70 of a rate, but look at the mortgage payment. So back in March of 2022, your mortgage payment, even though rates were lower, would be 4,465, so $4,465. You're actually now, even though rates have gone up, you're at 4,130. That's a $335 difference in your mortgage payment. So your maturity balance, so at the end of the 5-year term, you're going to be $137,000 less of balance that you owe in scenario 2 because you took advantage of the market even though rates were higher. And when you look at the bottom here in terms of how much savings you had based on down payment savings, mortgage insurance savings, the payment difference on the rate, even though it was higher, you're still saving about $35,000. So sometimes you need to look at purchasing in a different lens. You need to really break down the numbers so you can see that. And this is what we do. We show you opportunities in the market. Now, we know supply is not there in Canada. We know that population growth has gone 3 times worth in the last 12 months. The supply of owning a home or even renting right now is not there. So our value is going to go up? Yes. It's a matter of time. Once rates come down, we know the activity is going to be very strong. So these numbers will change. So when is opportunity to buy? It's today. And numbers really show you the truth of where we're at. So what people want right now is they want certainty. You want certainty on your mortgage. You want to know rates are coming down. You want to know that the market's going to be strong again. And I'm a big believer on stats because stats don't lie. They give us the reality of where we are today. I'm very excited to be able to present this to you because there's huge wins today in this presentation and the overall economy in Canada. We're seeing the resilience of where we've been, but we've also had 2 years of a hurdle of higher interest rates. And now we're seeing the downward cycle. We're seeing the forecast with one of the commonalities in all that I presented today was that there are no increases forecasted at all in inflation, in bank prime, and fixed rates. It's slow and steady. Slow and steady are the decreases on inflation, on interest rates, on variable rate mortgages, on bank prime. And so this is where you need to see the wins. And when you see the wins and you know the lack of supply out in the housing market, really when's the best time to buy? It's right now because we're showing you that with 100% certainty, rates are going to come down. Inflation is going to get to the target rate. We just don't know the exact timing. We can forecast and give you an idea of what we're looking at to help you position when you need to buy. But the reality is you really need to look at your financing today so that we can help you. And specifically too, if you're coming up for renewal, these are big years in the next 3 years of a lot of mortgages in Canada coming up for renewal. So making sure you understand where you're at can help you be very much stronger in positioning where you need to strategically have your mortgage and your mortgage product to be aligned so that you can save thousands on your mortgage. And I'm a big believer on mindset, right? And I always say this to a lot of people, especially when I'm doing presentations on resilience and where we need to be, is crisis is not a permanent condition. And we know this. We've been through a lot in this economy, a lot globally as well. And we know over time things will subside. And I do feel from an economic perspective, we are recovering now. It's going to take time, but we are recovering. And seasons are always temporary. So they will come and go, as we know, with winter season, summer, and spring. Much like the economy 100% recovers. It just takes time. And the key to life is to organize yourself to outlast the season. What is your resilient toolkit? What is it that's going to help you, give you a better perspective on what you need to do to align your mortgage, your financial wellness, so that you are winning on every aspect of your financing, so that you don't have the stress in your life and be able to have some huge interest savings and some huge win on investments if you're looking to grow your home ownership portfolio, or if you're paying down your mortgage aggressively, we can help you with these wins. It's just having the right mindset, right? Of looking at this as huge opportunities to take advantage now so that you can win in the future. It's all up to you. So thank you so much for your time. I'm here to be able to answer any questions. I have an outstanding team that is actively working with so many people in the communities across the country to help you with your financing and making sure that you have the best mortgage product and financial plan to really win in 2024 and beyond. Thank you so much for your time. Stay tuned for more options and opportunities where I'm going to be able to educate you on what's going on in the market. I look forward to another video with you in March. As we know, Bank Prime is going to be announced March 6th. And the third week of the month in March is going to be another inflation announcement in Canada. Again, if you have any questions at all, we're here to help you and win for 2024.